Okay, today, October 9th, major 300 points down or so, and they're doing the same stuff they did when Bernanke was in. Bernanke had a goal, and he said, this is what we're doing, and then these other little Fed guys get out and speak, and they dump the market. I'm sure if we investigated, it's only my theory, if you investigated their friends, he said we're going to speak, and we'll short the market and make the money. So now, here it is, Yellen takes over, and you got this loudmouth again coming in right here. This bank president, James Bullard, sending shakes and fears into the market, saying, oh, well, between the market's view and the Fed's rate hike path, its own view is concerning, and that scares the market, and everything tumbles. So if you investigate his friends and family and, one-offs, I'm sure you'll find somebody that played the market knowing he's going to speak to short it. They did it during Bernanke a couple of times, and they're doing it by Yellen. Now, if we really go ahead and take a look at it, and we see what's going on, I believe that we're still in a bear market. I mean, a bull market. I believe there's going to be good corporate earnings. It's just a shake-up, so these guys here that know they can control it actually go ahead and make the money. So here is CNBC.
So much for the gains of yesterday. The Dow is currently down by nearly 300 points. This is the 12th triple-digit move in either direction for the Dow in 18 sessions. A lot of volatility out there. Let's bring in Bob Pavlik from Banyan Partners and John Manley from Wells Fargo Funds. Bob, already
these guys are smart.
Guests on our show have suggested that this could turn into something that resembles a correction, 10% or more to the downside. Do you agree?
I don't agree. I think the market may have the potential to trade down to maybe the 200-day moving average, which is around 1905. When you step back and look at the bigger picture, we still have some positive data going on in the United States. Manufacturing continues to do well. The ISM manufacturing, durable goods, factory orders, ISM service index. We look at the job picture, the initial unemployment claims, the non-farm payrolls. All this is pointing to an expanding economy going on here in the United States. Really what the problem is the strength of the dollar, concerns about economic weakness overseas, concerns about the Federal Reserve. I think what you're going to see going on over the next few weeks is the earnings reports starting to stem some of this tide. I think what you're going to see better earnings reports, some cautionary comments from some companies, but going forward, you're looking at about 12% earnings growth for the S&P 500 next year, trading at a 14.5 times multiple. It's not that expensive. It could get a little bit less expensive, but I think going forward it works out.
Bob, just to follow up on the corporate profit side, I mean, to what degree and at what point will weakness around the globe, economically speaking, start to depress U.S. corporate profits?
Well, let's take a look at some companies that are out there. I mean, there are plenty of companies here in the United States that are going to attract foreign investors. Strengthening dollar is beneficial to foreign investors. Companies that do primarily most of their business here in the United States don't have that same kind of exposure. Home Depot, Lowe's, you take a look at maybe a Target or, some of the other retailers. They don't have that same kind of exposure. So those are the companies that it's going to initially attract attention. And then I think eventually you're going to see all this weakness in the energy sector start to attract even more attention because the companies have been hit so hard.
John, are you in the correction or no correction camp at this juncture?
I think it would be very unusual to have a correction. Moves down like this, very sharp, nasty moves, are typical, I think, of bull market corrections. So that I mean 4 to 7%. They're not bear markets. Bear markets start with slow loss of momentum. You don't have days like these in big bear markets, at the beginning at least.
What would you do strategically? You're a chief equity strategist. What are you doing right now, John?
I'm buying. I mean, I'm waiting a day or two. I want to see how the earnings come in from the third quarter, because I think your point on earnings are very well taken. I see no reason to believe that earnings won't continue to grow. I just want to see that to be sure. If they start to come in the way I think they will, where you have both gains in earnings and on the top line, that's going to start to mean a difference. And why is the Fed going to tighten? I've made a career out of believing that the head of the Federal Reserve is at least as smart as I am, which is to say a lot smarter. They're not going to do something like that.
That's exactly what I say.
Through a recession, they'll do what's appropriate, and by that I think Dr. Yellen means she'll do what is necessary to be done.
Just very quickly, what do you think is appropriate? When do you think they would first start hiking? And is it getting pushed further and further out, John?
Yes, I think it's being pushed further and further out. They'll only hike if they feel it has no impact on the economy. They've got to adjust for a stronger economy as they find it, but they'll try to have no impact to slow that economy down.
Bob, John, thank you very much for your thoughts on the market. We're going to bring you, though, the grip.
See, so that's what the whole thing is. You get these other guys that are understudies underneath Yellen and Bernanke, and they want to shake up the market and pull some profits. That's my theory. But these two gentlemen that were on there with this woman right here, they're smart. It's definitely a bull market. You got a little bit of a correction because price got a little too high. It's going to reset, and you'll look at the next leg or the next step. May not even be a leg, but that's where we're headed. We're still headed higher. Thank you.